Hey everyone, welcome back to Corporate Decoder, the place where we dive into the nitty-gritty of corporate filings and pull out the juiciest bits for you. Today we're looking at Certiplex Corporation's latest quarterly report, and let's just say things are interesting. Prepare for a wild ride through their financials and the story they tell, because it is not exactly a fairy tale. So what exactly is this document? Think of it as a company's progress report card for those last 3 months. It is where they tell the world and the SECI what has been going on financially and operationally. Certiplex filed this for the period ending the 30th of September 2025. Now before we jump into the deep end of the financials, let's quickly touch on ownership. As of November 2025, Certiplex had about 73.2 million shares of its common stock out there. That is the basic building block of ownership in the company itself. Alright, let's get straight to the heart of the matter, the balance sheet. This is basically a snapshot of what the company owns, what it owes, and what is left over for the owners at a specific point in time. We're looking at the 30th of September 2025 compared to the end of 2024. First up, cash. Companies always want to have plenty of this on hand. For Certiplex, it was about $7,810 on the 30th of September 2025. That is down from about $10,843 at the end of 2024. So cash is decreasing, not ideal. Then we have some of their assets. They list licensing rights at $94,575 and distribution rights at $25,000. These are considered intangible assets, meaning they're not physical things you can touch, but they still have value. They've stayed the same from 2024 to 2025, which is neither good nor bad on its own, but it means they haven't acquired new rights or let old ones expire in a way that changed their value on paper. Now let's look at what they owe. On the liability side, accounts payable and other accrued liabilities jumped from about $8,984 at the end of 2024 to $12,242 by September 2025. That means they owe more to their suppliers and for other short-term obligations. This is a bit of a red flag, showing their short-term debts are growing. Looking at the overall picture for liabilities, total liabilities were about $213,523 on the 30th of September 2025, compared to $182,122 at the end of 2024. So what they owe has significantly increased, and then to raise stockholders' equity. This is effectively the owner's stake in the company. For Certiplex, this number is actually a deficit. It means the company owes more than it owns. On the 30th of September 2025, their deficit was $81,284. That's a big jump from a deficit of $45,770 at the end of 2024. Essentially, the company is digging itself deeper into a hole from an ownership perspective. Let's move on to the income statement, or as they call it here, the statements of operations. This tells us how much money the company made and spent over a period of time, showing if it is profitable. We're looking at the 3 months ending the 30th of September 2025 versus the same period in 2024, and also the first 9 months of each year. First, revenue from sales. For the 3 months ending the 30th of September 2025, sales were $29,548. That is up from $17,779 in the same period of 2024. That's a good jump in sales. Looking at the 9-month period, sales were $98,374 in 2025. Slightly up from $93,824 in 2024. So sales are generally trending upwards, which is positive. They also have a small amount of income from card and bank rewards, which was $147 for the 3 months in 2025, compared to nothing in 24. And for the 9-month period, it was $437 in 2025 versus nothing in 24. This is a new, albeit tiny, source of income. This brings us to gross profit, which is what is left after you subtract the cost of making the product or service. For the 3 months, gross profit was $24,518 in 2025, up from $13,143 in 2024. This is great because it means the increased sales are actually flowing through to profit before other expenses. For the 9-month period, gross profit was $81,808 in 2025, compared to $76,993 in 2024. Again, the trend is positive. Now for the not so good part, operating expenses. These are all the costs of running the business, not counting the direct cost of goods or services. For the 3 months ending the 30th of September 2025, operating expenses shot up to $35,504 from $30,233 in 2024. And for the 9 months, they were $114,865 in 2025 compared to $117,072 in 2024. So, while the 9-month total is slightly down, the quarterly expenses are alarmingly high and growing. A big chunk of this comes from consulting fees and advertising. Specifically, you see consulting costs at $13,400 for the 3 months in 2025 versus $8,400 in 2024. For the 9 months, it is $34,200 versus $33,600. This consistently high or increasing consulting expense is a sign that the company might be relying heavily on outside expertise to run things, which can be costly. Because their expenses are growing faster than their gross profit, they are operating at a loss. For the 3 months, the operating loss was $10,986 in 2025, compared to a worse loss of $17,090 in 2024. For the 9 months, the operating loss was $33,057 in 2025, looking better than the $40,079 loss in 2024. So, they are losing less money in these periods, but they are still losing money. It's like they're trying to bail water out of a boat that's still taking on more water, but maybe at a slightly slower pace. They also have interest expenses, largely related to an SBA loan. For the 3 months in 2025, it was $729, up from $351 in 2024. For the 9 months, it was $2,187 versus $1,283. This shows their debt is costing them more, which is a direct consequence of carrying debt. And that brings us to the bottom line, the net loss. For the 3 months ending the 30th of September 2025, the net loss was $11,916, a significant improvement from a $17,441 loss in 2024. For the 9 months, the net loss was $35,514 in 2025, compared to $41,362 in 2024. While these are improvements compared to the prior year's losses, the company is still consistently losing money. That is the core of their financial story right now. Let's look at the statement of changes in stockholders' equity. This table shows how that complicated equity section we looked at earlier changes over time. As you can see, the accumulated deficit keeps growing. It was $314,935 at the end of 2023, and by the 30th of September 2025, it had ballooned to $408,284. This simply means the company has lost more money over its lifetime than it has ever made. It's like a running tab of all the bad financial years they've had. Consequently, the total equity figure is also a negative or a deficit. It went from a positive $12,065 equity at the end of 2023 to a deficit of $81,284 by the 30th of September 2025. This is a dramatic shift for the worse, showing the owner's stake has effectively evaporated and then some, meaning the company owes more than it is worth. Next up, the cash flow statement. This is crucial because a company can look profitable on paper but still run out of cash if it is not managed well. This tells us where the cash is coming from and where it is going. We start with the net loss, which we saw was $35,514 in 2025 and $41,362 in 2024 for the 9 months. The statement then adjusts this loss for non-cash items like depreciation, which we'll touch on later. Then we see changes in operating assets and liabilities. Accrued compensation, which is money owed to employees, significantly increased by $27,900 in 2025 compared to $14,350 in 2024. This indicates they owe their employees more. Accounts payable also increased. All these adjustments and changes result in the net cash from operating activities. For the 9 months ending the 30th of September 2025, Certiplex used $3,033 of cash just to run its operations. This might seem small, but it is actually better than the $13,955 of cash they burned through in the same period of 2024. So, they are using less cash from core operations, which is a positive sign, but they are still spending more cash than they are generating. Under investing activities, we see zero activity. This means they didn't buy any major assets like equipment or property. Essentially, no investment in their long-term productive capacity. In financing activities for the 9 months of 2024, they used $1,117, likely for payments on a note payable. In 2025, this category shows zero activity. This means they weren't borrowing money and they weren't making significant debt payments in 2025 from a cash flow perspective. At least not that shows up here. The net change in cash for the 9 months of 2025 was a decrease of $3,033, bringing their total cash down to $7,810. In 2024, the decrease was $12,836. So, the cash balance is shrinking, which is a concern for a company that already has so little cash. This next part is usually quite technical, but it is important. It is called accounting policies. Here, the company explains how they do their accounting. They mention depreciation, which is basically accounting for the wear and tear on things like vehicles over time. For their vehicles, depreciation was $360 for the 3 months and $1,080 for the 9 months in 2025. This number is the same as in 2024, which makes sense if they haven't bought new vehicles or sold old ones. It is a small non-cash expense. They also talk about intangible assets like licensing rights. For their Pro Sunday lighting system, the licensing rights were initially amortized over 10 years, but a change in September 2021 extended the term indefinitely, meaning they stopped amortizing it as of September 2025. These rights are valued at $94,575 on their books. This essentially means they don't expect the value of these rights to decrease over time anymore for accounting purposes. Revenue recognition is how they decide when to count money they've earned. They follow a 5-step process to ensure they only record revenue when it is truly earned. This is a standard accounting practice to prevent companies from inflating their reported income. Here is something interesting. Under their statements of operations, the line item for provision for income tax for all periods shown is a big fat zero. This is because the company has consistently lost money. In accounting terms, they have a net operating loss carry forward. This means they have so many past losses on paper that they don't owe any taxes right now, and they likely won't for some time. They even have a valuation allowance, which is like an accounting measure to acknowledge that the future tax benefits from these losses aren't guaranteed, hence offsetting the potential tax asset. So while they aren't paying taxes, it is a consequence of not being profitable. This is a really important note under going concern. They state that they've had recurring losses and a significant accumulated deficit, which amounts to over $408,000. Their total stockholders' equity is actually a deficit of over $81,000. They directly say these factors raise substantial doubt about the company's ability to continue as a going concern. This means the company might go out of business if they can't find more money or somehow become profitable very soon. They mention they are pursuing equity financing and strategic partnerships, but there are no guarantees. This isn't just a minor hiccup, it's a serious warning sign about the company's survival. Here they break down their business into segments. They have web-related services and product sales and licensing. It seems their licensing business, which includes things like the Pro Sunday lighting, generated no revenue in the periods reported. Almost all their revenue comes from web-related services. And within their segment disclosures, they show an operating loss of over $11,000 for the 30th of September 2025. And they also show a loss for the prior year. This confirms that even when looking at their individual business parts, they are not profitable. This section deals with agreements that could cost the company money in the future. They have a consulting agreement with their president, which requires monthly payments. As of September 2025, they had accrued over $147,000 in compensation for this agreement. This is a pretty significant related party transaction. They also say they are not currently involved in any other legal proceedings. This note just clarifies that the consulting arrangement with the president is indeed a related party transaction. It suggests that the terms might not be as favorable as they would be with an unrelated party, which isn't uncommon in these situations. They have a loan receivable, meaning they lent money to someone else. It was originally for about $34,940 at a 10% interest rate. By September 2025, the balance, including interest, was down to $1,064. So this loan is mostly paid back. This is about their debt. They have an SBA loan from 2020 with a principal of almost $50,000 at 3.75% interest. Repayments only started in November 2022. The loan is secured by the company's assets, meaning if they can't pay, the lender can seize their assets. The maturity schedule shows they have payments due in the coming years, with a significant chunk of over $40,000 due thereafter. Now we get to the management's own commentary, the management's discussion and analysis, or MD&A. This is where they explain their financial results in their own words. They describe themselves as a full-service multimedia company, focusing on business-ready solutions, website and app design, SEO, and content creation. They also mention owning the rights to the Pro Sunday lighting system and marketing it through distributors. They state their revenue comes from multimedia projects and licensing, but they haven't yet established a recurring revenue source sufficient to cover operating costs. This confirms our earlier findings. When they talk about the 3 months ending the 30th of September 2025 compared to 2024, they highlight increased revenues driven by multimedia and website design sales. They also note improved gross profit. However, they can't sugarcoat the operating expenses, which rose significantly due to consulting and advertising. For the 9-month period, revenues are only slightly higher. Gross profit is also up due to the revenue increase. Operating expenses are actually a bit lower overall for the 9 months, mainly because advertising and general administrative costs decreased, which helped offset increases in consulting and professional fees. They conclude that the net loss has decreased year over year, attributing it to improved gross profit and lower operating expenses. This statement is slightly misleading because while the loss is smaller, their operating expenses, particularly in the most recent quarter, showed a concerning increase. This section is all about how the company manages its cash. They mention their cash on hand has decreased, and their net cash used in operating activities, meaning how much cash they burn through to run the business, was also a cash outflow. They reaffirm that they haven't established enough recurring revenue to sustain operations and continue to operate with a stockholders' deficit. They are actively looking for more funding. Scrolly and addition, we are seeking potential acquisitions that fit within our business model. Scroll interestingly. They also mention seeking potential acquisitions, which is a bold move for a company that is struggling to stay afloat on its own. This could be seen as either ambitious or desperate, depending on your perspective. Here they discuss their internal controls. Their management, including the CEO and CFO, concluded that their disclosure controls and procedures were not effective. They cite material weaknesses in their internal controls. This is a significant admission. It means there are problems with how they record, process, and report financial information, which can lead to errors or even fraud. This part contains miscellaneous information. They state no unregistered equity securities were sold, no senior securities were issued or outstanding, and mining safety disclosures are not applicable. Finally, they list exhibits which are supporting documents. This includes certifications from their CEO and CFO regarding the accuracy of the financial reporting, which is a standard requirement. So, what have we learned from Certiplex Corporation's Q3 2025 report? On the positive side, sales are growing, and their gross profit, the money left after direct costs, is also improving. They are also losing money at a slower rate this year compared to last year. However, the picture is far from rosy. They are still consistently losing money. Their total liabilities are increasing while their equity is in a deep deficit, meaning they owe more than they own. Their cash reserves are dwindling, and crucially, they've admitted their internal controls are not effective, and their ability to continue as a going concern is in serious doubt. They are dependent on finding new financing to survive. The fact that they're looking for acquisitions while in such a precarious financial state warrants a lot of questions. Looking at this report, Certiplex Corporation is facing significant financial headwinds. Their growth in sales is overshadowed by rising operating expenses and a persistent net loss. The lack of effective internal controls is a serious concern that could exacerbate any existing financial problems or lead to new ones. Their survival hinges on securing external funding, and without it, the future looks very uncertain. It is a classic case of a company trying to grow its way out of trouble. But the numbers suggest they're fighting an uphill battle. Alright, that is our deep dive into Certiplex Corporation's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their sales growth is enough to overcome their financial challenges, or are they on thin ice? Drop your thoughts in the comments below. We love hearing your insights. If this analysis was valuable to you, please hit that like button as it really helps the channel. And if you want more of these corporate deep dives, make sure you subscribe and turn on notifications so you don't miss our next video. Don't forget to check out our Discord community linked in the description for more discussions and to connect with fellow finance enthusiasts. Thanks for watching, and we'll see you next time on Corporate Decoder.